Wall Street is asking the Federal Reserve Bank for a bailout again, and this time it's in the form of an emergency rate cut. An emergency rate cut is when the Federal Reserve Bank cuts interest rates during a time where they don't have a scheduled meeting. So the next Federal Reserve Bank meeting is scheduled for September 17th and 18th, and the Federal Reserve Bank has kind of alluded that they're going to cut interest rates in the September meeting. But now, because of the craziness that we saw in the stock market over the last week, you have a lot of people on Wall Street telling the Federal Reserve Bank, hey, I think we need a rate cut now, that way you can save Wall Street and save the investors. Now, this isn't the first time that we've seen this happen. The last time that we saw this happen was during the 2020 pandemic, when the stock market was selling off at the fastest rate we've ever seen. It was selling off even faster than the Great Depression. Then, of course, we had Wall Street say the same thing. Federal Reserve Bank, we need your support. We need your money. And so what did the Federal Reserve Bank do? They opened up the money printer. They started flooding the markets with more money. And then that saved the stock market. The stock market then rallied at the fastest rate we've ever seen in the history of time. The same year we saw the fastest stock market crash in the history of time. Where's the gold medal for that? Now, the thing that you have to understand, and if you've been subscribed to my channel, you already know this, is that the most expensive kind of money is free money. And there was a consequence to boosting the stock market. And the consequence was none other than transitory inflation. So what I want to do today is I want to talk about a Wall Street bailout, what that looks like, what the consequences would be, and what this means for you and how you can build wealth no matter what. Now, before we jump into this, I want to give you a quick reminder that on August 15th, 1971, that was when our monetary system changed, because that was when the dollar was taken off of the gold standard, which changed the way that our money worked forever. And that's why this year, on August 14th and 15th, 2024, I'm hosting our biggest investor workshop of the year, where I'm going to be going over, number one, how our money has changed over the last 5 decades, but also how our money has changed over the last 5 years. And then more importantly, I'm going to be going over new investment trends, new financial trends, and how you can build wealth in this changing economy during a time where we have crazy things happening in the markets, during a time where interest rates are still high, during a time where inflation is still high, during a time where there's a lot of uncertainty. How can you find the opportunity and how can you build wealth? It's completely free. It's virtual. I'm hosting it 2 times, once on August 14th, once on August 15th. I would love to have you there. Just make sure you register, because there's a limited number of seats. There are people that can join me live. So if you'd like to join, I got the link for you to join down in the description below. Now, just so we're on the same page, let me define what the Federal Reserve Bank is, because the Federal Reserve Bank is the central bank of the United States. Many people call them the Fed, but although they're called the Federal Reserve Bank, they're not federal. It says so on their website, meaning they're not a part of our government. They're not a reserve because they don't keep any cash reserves. And they're also not a bank, because you and I can't go there to deposit money. Now, although they're called the Federal Reserve Bank and they're not federal or a reserve or a bank, they do have some special powers. And those powers include, number one, being able to control interest rates, and number two, being able to control and manipulate our monetary supply, meaning the amount of money that we have. The Fed wants to pay attention to 2 things. Thing number one is inflation, and thing number 2 is unemployment. Now, what they say technically is that the Federal Reserve Bank wants to look at price stability, which is what inflation is, and then they want to look at maximum employment, which is the unemployment numbers. These are the 2 things that the Federal Reserve Bank is supposed to look at. That's what it says in their bylaws. And based off of what they see with inflation, based off what they see with unemployment, they then are working to regulate our money to balance these 2 things out. And the way that they do that is by raising or cutting interest rates, and by printing money or removing money from our economic system. So how does that work? Well, when you see an economic slowdown, then the Federal Reserve Bank will want to stimulate the economy. The way they stimulate the economy is by encouraging people to spend, because we live in a spending economy. We live in a consumerist system where when you spend money, somebody else makes money. The more money you spend, the more money somebody else makes. And our system runs on spending. So if you're spending money and people start to spend more money, that can help grow the economy. Because if people are spending money, people start buying homes. If you're buying a home, that means a realtor is going to get a commission check. If a realtor gets a commission check, they have the ability to pay their mortgage. They have the ability to go out and buy a new car. They have the ability to go to the Gucci store. They have the ability to buy the extra guac, which then helps those businesses make money and spend money as well. But remember, we don't just live in a cash-based system, we live in a credit-based system. What that means is if you make $50,000, well, you can spend $50,000 But you can also spend $70,000 with the help of credit cards and lines of credit and other types of debt. So the first way that the Federal Reserve Bank can help stimulate spending is by making borrowing money cheaper. And the way they do that is by lowering interest rates. That's what we saw happen during the 2020 pandemic. Markets crashed, the economy crashed, and the first thing that the Federal Reserve Bank did was they cut interest rates to the lowest levels ever. What does that mean? Well, now when you go to get a mortgage, it's a lower interest rate. If you wanted to buy a car, it's a lower interest rate. You want to put money in a credit card, it's a lower interest rate, which then makes it more enticing for people to spend. I mean, we all remember the boom in the housing market in 2021 and 2022 and even into 2023 and even today. I mean, it's still very hot, but not as hot as it was back in 2021 and 2022. What boosted all that? Well, it was the low interest rates. Remember, the Federal Reserve Bank was working to stimulate because we were in a very slow economy because the economy was shut down. And so to stimulate, the Federal Reserve Bank cut interest rates. That's the first thing that they can do. The second thing that they can do is this type of quantitative easing. Quantitative easing is a fancy way of saying printing money. And then they can take this money and put it in different places. One thing that the Federal Reserve Bank can do is they can lend this money to the United States government. That's generally what they do. That way now the government has more ability to spend. The United States government makes money from taxes. You go to work, you get paid, some of that money goes to the government in taxes. You start a business, you make money, you pay taxes. You buy something, you pay sales taxes. You own a property, you pay property taxes, right? The government makes money from taxes and then they spend that money. They might spend their money on bridges and infrastructure and the military and social security and healthcare and a whole bunch of other things. But then what the government does is they spend money that they don't have. But when the government spends money, they're still stimulating the economy, right? Because if the government wants to go and build a bridge, they're going to hire construction companies. And those construction companies have to pay for construction workers. And those construction workers now make money. And when they make money, they have the ability to go out and buy trucks and food and homes and groceries and clothes and vacations. So the government is also a big spender, actually the biggest spender in our economic system. But the government, again, kind of runs like a person that doesn't know how to manage their finances because the government doesn't live off of the cash that they generate. The government spends money based off of how much credit they want to spend. Now, earlier I talked about how in 1971, the dollar was taken off of the gold standard. What that means is now the Federal Reserve Bank has the ability to print essentially unlimited amounts of money because they don't really look at how much collateral the government has. Previously, gold was the collateral. Previously, the Federal Reserve Bank needed more wealth, aka gold, in order to print and justify more printing. Now, you don't need that. So, in order to stimulate the economy, the Federal Reserve Bank can do quantitative easing, meaning they can print money and lend it to the United States government, and then the government can spend this money. And they can spend it however they want. They can hire construction companies. They can give out checks to people. They can give out unemployment checks. I mean, the government can really do whatever they want. They can create whatever types of program that they want to inject money into our economic system, which then gives more money into the hands of people. It gives more money into the hands of businesses, which can then stimulate spending, which then stimulates growth. But there's the consequence to free money. I talked about this just a few minutes ago. The most expensive kind of money is free money. And that consequence, well, what we saw was transitory inflation. And what I mean by that is if you don't know who's paying the price, then it's probably you. Because now when the government spends money that they don't have through the Federal Reserve Bank printing money, then what that means is somebody still has to pay. I mean, if nobody had to pay, then why didn't the government just raise taxes? Actually, if nobody has to pay, why do we have to pay taxes in the first place? If the government can just get that money printed by the Federal Reserve Bank, it's because there's a consequence. And the consequence is inflation. And the person who pays the price is the person that doesn't understand what inflation is. And unfortunately, that's the majority of Americans. The majority of people are not financially educated. They don't understand how our economic system works. They don't understand how money works. So now you go to work to get paid. You go to potentially save some money, but you're also working to pay your bills. And what we've seen happen, not just over the last 5 years, but over the last 5 decades, is that inflation has outpaced wages. So you work to get a raise, which is great. But the prices of things are growing faster than your income. So you got a raise, you feel good. And now you work to spend more money, but you don't feel any richer. And the reason why is because you're still spending more of your paycheck for your home. You're spending more of your paycheck on your car. You're spending more of your paycheck on your groceries. So you got a raise, you spend money, and then you still have less money left over to save and invest. And on top of that, the majority of people, even if you're making more money than inflation, the next problem is the majority of people have no idea how to spend their money. So even if you are getting bigger raises, now you go out and buy nicer cars, you buy nicer things and nicer vacations, nicer clothes, and then you have no money to save or invest as it is. That's the consumer problem. So we have the system problem, we have the consumer problem. Now, what I'd like to teach is how do you fix the consumer problem, right? Because at the end of the day, we can complain all day and night long about how the system works, but that's not going to fix your financial situation. I want you to understand the system, that way you can take advantage of the system, but complaining about the system does not fix your financial situation, which is why what you got to do is once you understand this, figure out how you can break out of this mess. And the way that you do that is by number one, stop spending all of your money. And yeah, it's a lot harder when a time where inflation is hot, but you got to make the sacrifice because the reality is inflation makes investors rich. Inflation makes stock prices go up. Inflation makes real estate prices go up. Inflation has benefited investors. Asset prices have grown way faster than wages. If you look at the last 5 years, wages grow by 20 to 25%, while the S&P 500 has grown by many multiples of that. The stock market has grown by many multiples of that. So you have the rich getting richer, and the average person is getting poorer. Why? Because your income is not keeping up with inflation. So even if you get a raise, you still can't afford the same lifestyle that you had before. This is why your financial education is so important. This is why I want you to understand how the system works. And this is why I want you to become an investor, because investors are the ones that win in this financial system. Now you can hate it, you can love it. I want you to understand how the system works. Now there's some people that say don't fight the Fed. We don't know what the Federal Reserve Bank is going to do. I made this comment a little while ago, but financial opinions are like armpits. Everybody's got a couple, and some stink more than others. Everybody has an opinion on what the Federal Reserve Bank is going to do. Everybody has an opinion on what's going to happen with interest rates. Everybody has an opinion on what's going to happen in the economy. Who cares? It doesn't matter what the opinions are. I want you to cut through the noise, cut through the emotion, and understand how can you build wealth regardless of what's happening, regardless of what's happening in the economy, regardless of what's happening with interest rates, regardless of what's happening with inflation. How do you build wealth? The way that you do that is by not spending all of your money, building some savings, having some investments, working to build the cash flow. But the only way that you can do that is if you stop spending all of your money, which means you're going to have to make some serious personal sacrifice. And that's not easy, especially during a time where the economy is slowing, especially during a time where inflation is hot. I get that. But if you want to build wealth, you got to be the one that makes that change. Now, I get it. I'm just a random guy on YouTube. But everything that I talk about is from my own experiences and my own mistakes. I don't recommend what I do, and I can't tell you what to do, but I want you to understand that if you want to build wealth, it starts with you controlling your spending. Then you work to invest your money. Then you work to earn more money. That we have more money to invest. I call it a decade of sacrifice, where you're working to live below your means. That way you have more money to invest. That way when you see an economic slowdown, you have the financial education. You have the cash to take advantage of the opportunity. That way you can become wealthier, because the reality is recessions and market crashes create more millionaires than any other time. But the only people that can actually capitalize on them are the people that are financially educated, are the people that are financially prepared, meaning you have the cash to protect you and you have the cash to capitalize on that opportunity, and you understand the financial trends. That's what it takes to really build wealth. And I understand that that can be overwhelming, but it starts with learning. Start by watching free videos on YouTube. Start by watching free podcasts. Start by reading blogs. Then maybe you read some books. Then maybe you attend some workshops. My Investor Summit, that's free. I'm going to be going over things like this. Then maybe you read some books. Then maybe you buy some classes. Then maybe you buy some coaching. I mean, it's all stages, but you just got to get started. And experience is the best teacher. You got to understand, you will lose at some point. Every investor loses money. Losing is a part of the process. The goal is to make more than you lose. And investing is a long-term game. Don't get caught up in the day-to-day emotions. Understand the trends, and remember, if you're a long-term investor, you're investing for years or decades, not just a few days or weeks or months. Don't get caught up in the day-to-day stuff. Understand what your goals are. Invest for the long term, stick with the strategy, and keep learning. That way you can build wealth. So now that we laid the foundation of how our economic system works, how the Federal Reserve Bank works, and how our money works, let's go back to the topic of this video. Wall Street wants a bailout. Why? Because they want to see their investments continue rising. What does that mean? Well, an emergency rate cut is what Wall Street is asking for right now. An emergency rate cut is that the Federal Reserve Bank would come out before their next meeting, have an emergency meeting, and then they announce that they're going to cut interest rates as a way to stimulate the economy. Now, there's a couple of ways that that would benefit Wall Street. Number one is that makes debt cheaper. That's good for consumers. That's good for Wall Street, in the sense that if you wanted to go out and spend money, it is cheaper to do so. It's not good for consumers in terms of your financial health. It's good for consumers in terms of spending more money. which then would boost business, because if now you can spend more money, you can buy more extra guac for Chipotle, it's good for the Chipotle bottom line, it's good for Walmart, it's good for Kroger, it's good for Amazon, which then benefits Wall Street. But it also benefits Wall Street because these institutions and hedge funds don't just trade and invest on cash, they invest on margin, meaning debt. And so if interest rates go lower, that means that Wall Street institutions can go out and borrow money for cheaper, and then they can go out and invest more dollars. That's why they're looking for these lower interest rates. But again, is there a consequence? Of course. The consequence is inflation hasn't gone away, and you risk making the inflation problem worse. Now, this is where the Federal Reserve Bank and the government says, no, the inflation problem's over. We wouldn't make the inflation problem worse. But it's something you have to think about because the inflation problem is still around. And if people start to spend more, you start to see more bidding wars on homes. You start to see more people go out and buy cars. It's nice because you have more stuff, but that could push the prices of things up, which again could push up asset prices, which again benefit investors. But if you're not an investor, it could hurt you. And so the way that you win now is building that financial education, understanding what's happening, building an investing strategy, and looking for opportunities. That way you can win no matter what's happening in the economy. So I'd like to hear from you. What do you think the Federal Reserve Bank should do? Should they cut interest rates right now? Should they cut interest rates in September? Or should they wait to keep interest rates higher for longer? Let me know what your thoughts are down in the comments. After a rough Thursday, the stock market had an even rougher Friday. On Thursday, we found out that manufacturing in the United States shrank for 4 straight months, which had investors starting to worry about a recession, and we saw the stock market fall. Then on Friday, we got more bad economic news. We got the unemployment data,